Welcome to the Retirement Made Easy podcast. I'm your host, Greg Gonzalez. My goal for the podcast is to help you live a better life in retirement by giving you the tools and information you need in a language that you can understand. On today's episode, we're going to be talking about the financial opportunities that have arisen due to COVID-19. And yes, there are some financial opportunities out there in the middle of a pandemic. Some of these opportunities may or may not apply to you and your situation, but they certainly apply to some people out there. When you can turn a challenge like a pandemic into an opportunity, you'll be able to withstand and even thrive in this kind of environment. It just kind of takes a watchful eye to look for those opportunities. They will pop up. Maybe it's a new law like the CARES Act that was passed that presents an opportunity for you. On today's episode, we're going to talk about the 4 financial opportunities that have arisen due to COVID. But before we get into today's content, I wanted to remind listeners to check out our website, which is retirementmadeeasypodcast.com. It's a mouthful, but again, the website is retirementmadeeasypodcast.com. There you can check out our retirement secret sauce, as well as our 2020 tax planning guide. Those are both available for free on the website. You can also listen to previous episodes if you would like. So check out our website. And while you're there, I always welcome listeners to email me or send me any questions you might have. I always enjoy hearing from the listeners of the podcast. The first financial opportunity amongst this pandemic from COVID-19 that I wanted to highlight was the drop in interest rates. And for some, this is an opportunity, and for others, it's going to be a big challenge. But you may remember in middle of March, the Sunday, March 15th, 2020, the Federal Reserve announced an emergency decrease to the federal funds rate. And what followed after that was, of course, banks were decreasing all of their interest rates that they paid for not only money markets and CDs and savings and checking accounts, but also lenders, like mortgage lenders. Over the next few months, mortgage rates for new loans and for those that were refinancing saw a drastic drop due to this decision nationwide to cut interest rates. So while people are very unhappy that their bank accounts, their money markets and CDs are paying next to nothing in interest nowadays, on the other hand, millions of Americans were able to refinance their existing home loans and take advantage of these historic low interest rates. And by doing so, they saved themselves a lot of money on interest payments throughout the life of their loan. I was actually one of these people that was able to refinance to a 15-year mortgage in the low 2s, and my mortgage broker said she was as busy during this time of people refinancing in COVID as any year in her 25-year career as a mortgage lender. That's pretty amazing. But what she also said was the lenders were looking more at credit score than they had in the past. So it was more critical to getting a lower interest rate if your credit score was over the 720 figure. Another thing that was very interesting in working with my mortgage lender was the fact that she said the closing period is now 60 days, where beforehand it was a lot shorter. But she said there are just people literally lined up to refinance their mortgage and take advantage of these historic low rates. She said she actually got someone a 15-year refinance of 1.95%. That's just incredible to me. And another person was able to lock in a 30-year, 2.25% mortgage. That's just unheard of, absolutely unheard of. If you would have told me last year that, hey, in the next 12 months, people are going to be refinancing their mortgage to a 30-year, 2.25%, I would have told you were crazy. But it happened. So hats off to the people that are taking advantage of the low interest rates and refinancing, and people will continue to take advantage of these low interest rates probably until you start seeing the Fed increase those rates. which Lord only knows when that will be. So, when interest rates are low, it's a great time to refinance your debt. Mortgage is typically our biggest debt for our household. So refinance, save yourself some interest payments. And for me personally, I think it saved $250 a month on the payment just by going from, I think I was in the fours to roughly 2.25% interest rate. So I was very, very satisfied. The next opportunity that has popped up for those that were laid off or furloughed, they are finding themselves in a lower tax environment for 2020, simply because they didn't have the earnings they would have in a regular year because they had that time when they were laid off or furloughed. For a simplistic example, let's say someone normally makes $100,000. The household income is $100,000. Let's say they were laid off or furloughed for 6 months, and now they were only working 6 months of the year, so they have $50,000 of household income. What might this individual or this couple consider doing? So what a lot of people are doing, based on the recommendations of their CPA and their financial planner, is they're considering converting part of their retirement accounts to a Roth IRA. Effectively, you're paying the taxes now in this year that you're faced with a low tax environment simply because you were laid off for 6 months. So it might make sense to do a partial conversion from a traditional IRA to a Roth IRA. Or if you have say you have an old 401k, you convert part of your traditional 401k to a Roth 401k. In this example, this couple might consider, and again, they would want to seek guidance from their financial planner and their CPA, but they might consider converting enough of their IRA to a Roth IRA while still keeping them in the 12% federal tax bracket. Meaning you convert up to the exact dollar that you need to stay in the 12% federal tax bracket this year. And if you were to convert one more dollar, it would be taxed at 22%, which is the subsequent tax bracket. In other words, you get to the ceiling of the 12% federal tax bracket and you don't convert a dollar more. That might be a strategy that this couple considers. And this is quite common for those that find themselves in a lower tax situation in a year where maybe they didn't have the earnings that they normally have. One of the strategies is to implement these Roth conversions in your portfolio. Pay the taxes while they're low and while you're in a low tax year, and then they can grow in a Roth IRA or Roth 401k, grow tax-free essentially the rest of your life. So while it's unfortunate that we may not have the earnings this year in 2020 due to layoffs and furloughs, the opportunity is possibly a Roth conversion. So consider that if you happen to be one of those people in that situation. The next opportunity was given to us by the CARES Act. And the CARES Act came out as a result of the COVID-19 pandemic. And one of the provisions in the CARES Act says that if you're one of those people who in a normal year has to take a required minimum distribution from either your 401k, IRA, maybe it's an inherited IRA, in this year for 2020, you get to skip that required minimum distribution. In other words, you don't have to take the required minimum distribution and pay taxes on it. This is a 1-year freebie that you don't have to do so. So by not taking the RMD, it might put you in a lower tax situation. And in turn, that might sway your decisions about what you do to your entire portfolio. Maybe you harvest some gains if you're in a lower tax situation. Maybe you do a Roth conversion of your IRA or 401k in this year. Normally, you have to take the RMD, and by converting your IRA or 401k, that doesn't count. Conversions don't count towards a required minimum distribution. So 2020 is really a special year when it comes to planning due to, well, a lot of different things, but one of these is the CARES Act. If you haven't read up on the CARES Act, I would encourage you. We'll try to include a link for the CARES Act where you can read all about it. But another one of the provisions for the CARES Act was for those people that were directly impacted from COVID-19, and you can read what exactly that entails. But if you were directly impacted from COVID-19, you can take a distribution from your IRA up to $100,000. And even if you're under 59 and a half, you could theoretically stretch that tax burden out over 3 years. So let me give you an example. Let's say someone, Susie, is 55. She is directly impacted from COVID-19, loses her job. Maybe she contracts COVID-19 and she needs the income, needs the money. So she takes a distribution from her IRA of $100,000, which is the maximum. She would be able to stretch the tax burden. The taxes would be $33,333 in 2020. The next year, 2021, she would be responsible for paying taxes on $33,333. And then finally, in 2022, she would pay the residual of $33,333. Even though she received the money in 2020, she's able to stretch the tax burden out over 3 years, which is very, very nice. So you might check with your CPA or your financial planner if you have one and see how the CARES Act might benefit you or impact you, if at all. The next financial opportunity that came about due to COVID-19 and the pandemic was in March. We all saw what happened to the stock market in March. And for those of us that were adding to our investments every month, you were so glad you did. The market seemed to really decline in the month of March and actually bottomed out. The S&P 500 bottomed out on March the 23rd. It was down 31% since January 1st. So just in those, 2 full months and 23 days, the market was down 31%, the market being the S&P 500 index. The Dow Jones Industrial Average on March 23rd closed down over 35% and bottomed out again on March the 23rd. Since then, of course, the market has recovered. But the opportunity there was for all those folks who were adding to their investments. Maybe it was a 401k or 403b every paycheck. Maybe it was a Roth IRA or SEP IRA or other type of investments or retirement accounts you have. This is why we stress the importance of doing what's called dollar cost averaging, buying in on a frequent basis. Maybe it's every paycheck, maybe it's every week, every 2 weeks, every month. The benefit of doing so allows you to purchase shares at a reduced price. So when the market is down for the year like that, you're able to really pick up a bargain, so to speak, while the market is underpriced. And think about that. If you happen to buy in to your index fund, mutual fund, ETF, whatever it is, you're buying into some investment that follows kind of stocks in the stock market, and it's down or it's undervalued by 31 or 35%, you're kind of buying at a discount. And again, you don't know how long it's going to take to recover to where it was. Like in this case, on January 1st, it was 31% higher than it was on March the 23rd. I tell clients all the time, we like buying our groceries on sale. We like buying our clothing at a discount. But our investments, whenever they are underpriced or the market starts to tumble and the prices go down and down and down, people are sometimes fearful of adding to their investments at that point because they think they're damaged. There's something wrong with them. The market has just priced them at that point at a lower value. And the market gets priced throughout the day. The stock price of Coca-Cola, literally while the market is open, is adjusting by the second. Imagine if you were grocery shopping and the price of bananas literally adjusted by a penny or two every second you were in there. That would be incredible. By the time you got to the checkout, you wouldn't know what they were worth or what they wanted you to pay for them. So this pandemic in March, kind of the market, like I said, the market indexes bottomed out on March the 23rd. So it offered a really fantastic investment opportunity for maybe long-term investors. We know, well, at least most people know, you can't time the market. You don't know when the next pandemic is going to come along and is going to cause the stock market and your investments to fall that fast, that quick. But if you are contributing consistently, deliberately, every paycheck, every month, every week, however you do it, you're going to have that ability to purchase into the investments, mutual funds, whatever they might be, while they are fluctuating in price, and discounts are to be had. Let's say Coca-Cola drops 20%. Has something happened in a month or a month and a half for Coca-Cola, the value of the stock price? Has something happened fundamentally to Coca-Cola? Or is the market as a whole driving the stock price of Coca-Cola down just with everything else? That's for you to decide maybe at that point, or you and your financial advisor. But we do know that during a pandemic or something as significant as this, sometimes there are buying opportunities for investments. Sometimes it's even real estate, depending on the market conditions. So where there's challenges, there's opportunities for the watchful person out there. And lastly, I wanted to mention a resource for listeners. I get asked all the time, how do I find out about where interest rates are and what online money markets and maybe online CDs are paying? So I wanted to share a website which is called bankrate.com. Again, that's bankrate.com. You can get an idea of what CDs, and it's a nice filter that you can find interest rates on not only bank accounts, but also CDs, that kind of stuff. So check out that website. I have no affiliation with it. I don't get any benefit from bankrate.com. So again, no affiliation there. It's just a good overall website to check out if you're curious about where money markets are and CDs and interest rates. Good resource out there, and it's free. You don't have to sign up or anything like that. Hey, today's episode was a lot of fun for me. I hope you enjoyed it out there. I want to remind listeners, check out our website, which is retirementmadeeasypodcast.com. That's retirementmadeeasypodcast.com. If you have questions or you want to contact me, feel free. There's a section at the bottom of the website where you can ask Greg a question. Until next time, take care, and remember, always dream big. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, please consult your attorney, tax advisor, or financial advisor prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. The SmartVestor program is a directory of investment professionals. Neither Dave Ramsey nor SmartVestor are affiliates of St. Louis Retirement Advisors or LPL Financial. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC. Traditional IRA account holders have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting your Roth IRA. Dollar cost averaging involves continuous investment in securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to continue purchasing through fluctuating price levels.